Hello and welcome to our market alert video for today, which is February 21, 2025. I hope this video finds you healthy, wealthy, and wise, and that all is well with you. Boy, I'll tell you, it is so cold here. Our headquarters are in Plano, Texas, which is in North Dallas, and it's 22 degrees today. And it was 12 degrees a few days ago. Oh my gosh. So I hope you are staying nice and warm and that you are not freezing like we are over here. So we're going to talk this week about our how to plan for 2025. There's a lot of uncertainty. Tariffs, the Federal Reserve doesn't even know what to do. The Federal Reserve reminds me of John Travolta in Welcome Back, Kotter. Okay, there's a reference for you. So if you're old enough to remember that, John Travolta would always say, "I'm so confused. The Federal Reserve does not know what to do." So how on earth are we supposed to know what to do if they don't? So we're going to talk about how to plan for 2025. Before I go further, let me introduce myself. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And we're a firm that specializes in working with people who are over 50, who are retired or retiring soon. So if that's you, this video is designed for you. Our website is rpoa.com. And if you go there, you can check us out. Please like and subscribe this video. Really would appreciate it if you did that. So let's dive in. How to plan for 2025. Okay, so first of all, I want to tell you what our fearless forecast for the year is. And that is an 11% gain in the stock market. And we're using the Dow as our benchmark here. And so an 11% gain would put the Dow at around 48,000 for the year. So when we say that, what we mean is it's the high watermark. Okay, so it's not what the end of the year is. We could reach it in July. So it's the high watermark for the year. And so we're very bullish on where we go this year. Okay, so why? Well, number one is that we think there's going to be a lot of deregulation. The Trump administration, despite all the presidential stuff that they've been doing, these executive orders, they haven't gotten around to deregulation. And deregulation lowers the cost for businesses, makes it easier and faster for them to do business. And if that's the case, their profits should go up. And as you guys know, we think profits drive stock prices. So if profits go up, stock prices should go up as well. So that's one thing. The other thing is that when we look at inflation, our view is that inflation should either stay where it is or trend downward over the next few months. And if that's the case, that bodes well for consumers. They are 70% of the economy. And if they buy stuff, then profits come and stock prices react accordingly. The other thing also is interest rates. So the Federal Reserve, they're going to move interest rates probably very in tandem with what inflation is doing. So if inflation stays the same, then guess what? They should leave interest rates where they are. If inflation starts to go down, they may start lowering interest rates. So in both of those cases, that bodes well for the stock market, because if interest rates stay the same, companies are profitable. But if they go down, the cost of money is lower, then that's even better. So that's good for stocks as well. So the other thing also that we think is that tariffs are not going to be the big economy killer. Inflation is going to skyrocket because of it at this point. And if I don't want to get into a long discussion about that with you this week because I did it last week. So go watch last week's video and you'll see our thought behind all of that. And then finally, jobs. So of course, again, the consumer is 70% of our economy. Therefore, they need jobs to be able to buy stuff, right? And so therefore, we look at jobs. And jobs have remained relatively strong to the surprise of many, despite all this inflation and everything else. But one thing also that we're factoring in is these tariffs that President Trump is talking about. He's talking about reciprocal tariffs. So if it costs companies so much to sell their product in this country, if they manufacture it overseas, they should come over to this country and produce them here. And there's already talk of that happening. And if it does, then guess what? That's jobs for Americans. And if that happens, then the job market should stay strong. So for all of those reasons, we think Dow 11% gain for the Dow is in the cards. So we're bullish. Now, one of the things I want to warn you about is that every year, on average, we have 1.5 corrections. Okay, so averages. So what that means is some years we have one, some years we have two. But if you go back 50 years, we've had a correction almost every single year. Now, what is a correction? A correction is when the stock market, or a stock for that matter, the S&P, the Dow, or even, like I said, an individual stock that goes down from its peak by more than 10%, but less than 20%. So if it's within that range of going like that, that is called a correction. Now, if it gets more than 20%, it becomes a bear market. Okay, so that's a distinction. So we think it's very likely that this year we will see a correction of 10 to 20%. And we think that will end up being, given our fearless forecast, a buying opportunity. So therefore, don't panic. In fact, make sure you watch this video every week so that you get our take on it and see what we think. Now, having said all of that, we have a philosophy that is one of our investment principles, and that is that growth is important, but protection of principal is even more important. Okay, so if you're within 5 years of retirement, or you're in the first 5 years of your retirement, that decade, we think it's the most important decade of your entire financial life. During that period, we think that taking large losses could be devastating. And so therefore, we believe you should have a strategy to address that. In our firm, we do. We call it Invest and Protect. And as you guys know, it told us to sell in November of 2007. And the clients that followed our advice were out of the stock market for all of 2008 during one of the biggest market crashes in our history. And also when the pandemic was announced, the day before that, our strategy said to sell. And they shut down the economy and the stock market went down like a stone. And we helped to avoid much of that with our strategy as well for our clients. So growth is important, but protection of principal is even more important. So even though we have a bullish forecast, something could come out of the blue to change everything, and it's important to have a strategy to address those things. You don't want to take a big loss if you're in that decade. At least that's what I think. Am I right? And so we want your money to last as long as you do. We want you to have financial peace of mind, and those are our two directives, if you will. One of the things that also we have fun with is what's called creating squippers. And when a client of ours retires, we call them a squipper. And SCWPS is the acronym for Second Childhood Without Parental Supervision. And so we want you to go play, have fun, enjoy it. You've earned it, right? You should go and be a kid again. And let us get the gray hair for you so that you don't have to. Okay, so if that appeals to you, go to our website. It's rpoa.com and check us out. While you're there, make sure you listen to our podcast. We had close to 300,000 downloads over the last year. And if you're not one of them, you may be missing out. Who knows? Maybe you'll like it. So check it out. And also, please like and subscribe to this video. Really appreciate it. So thanks for watching, and we'll talk soon.
Retirement Planners of America.